Well, a very good afternoon, unit holders of Digital Core REIT. Thank you for joining us this afternoon at the SIAS Digital Core REIT Pre-AGM virtual dialogue session. As you know, we organize these dialogue session for you to connect with the senior management of Digital Core REIT and find out more about the resolutions that need to be passed during the upcoming AGM. As you know, the AGM will be held virtually on 20th April at 8:30 a.m. Singapore time. Today, we are pleased to have with us Mr. John Stewart, the CEO of Digital Core REIT Management. Welcome, John, the manager of Digital Core REIT. And the last time you spoke with my colleague, I remember it was Robson. The world was quite different. Today, we look forward to an informative session along with your unit holders who are eager to hear insights from you directly from the source. So this dialogue will cover important questions that your unit holders have since you are fairly new, as Digital Core REIT was only listed in December 2021. We will be asking you, amongst other questions, for your insights on the data center business and the impact of high interest rates on DPU. Unit holders also want to understand, I believe, your strength as a data center landlord and why they should invest in this REIT. And of course, we will also address the growing pains and the operational risks. So we will kick off the session with a presentation by John, followed by a Q&A session together with the CFO, Daniel Tith. Please submit your questions, shareholders, via the Q&A function of the Zoom webinar, and the management will endeavor to address all of them. Without further ado then, I'll call on John to take us through with the presentation. John, over to you. Thank you.
Thank you, Mr. Gerald, and thank you to all our unit holders on the call for joining us and for your support of Digital Core REIT. Before we dive into our presentation, I'd like to set the stage by taking just a moment to provide a brief introduction to Digital Core REIT. We are a pure-play data center REIT sponsored by Digital Realty, the largest global data center owner and operator. We own interests in 11 institutional quality data center facilities in 5 markets across the US, Canada, and Germany. We maintain a flexible balance sheet with current leverage of 34%. We have a global investment mandate, and our sponsor has granted us a global ROFR. The current pipeline of sponsor assets that meet our mandate is over $15 billion US, which we believe provides us with an industry-leading runway for growth. Finally, as Mr. Gerald mentioned, we are slated to host our inaugural AGM at 8:30 a.m. on Thursday, the 20th of April, and we would very much appreciate your support on the resolutions to receive and adopt our 2022 audited financial results, to reappoint KPMG as our auditor, and to refresh our general mandate and unit buyback mandate. With that, let's turn to our presentation, beginning on page 5. Is everyone able to see the presentation? One more page, please, page 5, thank you. So beginning here on page 5, Digital Core REIT delivered solid results in 2022, despite a rapidly evolving environment. Our portfolio of mission-critical data center facilities concentrated in top-tier global markets remained almost fully leased and generated better than expected cash net property income, supporting a full-year distribution per unit of 3.98 US cents, within 5% of our IPO forecast, despite the headwinds from higher interest rates, rising energy costs, and a customer bankruptcy. We also began to deliver on our external growth strategy, closing on the acquisition of a 25% interest in a state-of-the-art freehold facility in Frankfurt for US $150 million. The Frankfurt facility was purpose-built from the ground up as a data center by Digital Realty in successive phases of contiguous customer expansion from 2017 through 2022, and is approximately 91% leased to leading global cloud providers and IT service providers. This transaction delivered significant strategic and financial benefits for unit holders, establishing a presence in a new region and a top-tier global data center market, improving geographic and customer diversification, achieving scale, and enhancing overall portfolio quality while generating 2% DPU accretion. We believe our sponsor acquisition pipeline is unparalleled in the industry, and this transaction demonstrates our ability to execute upon our external growth strategy and deliver attractive DPU accretion despite challenging capital markets conditions. We generated another 1% DPU accretion through the repurchase of nearly 11 million units. We executed the unit buyback at an average price of 58.5 cents, or a 30% discount to NAV and a 6.8% DPU yield. When we have ample liquidity and all material information has been disclosed, we believe that buying our assets in the public market at a meaningful discount to intrinsic value represents a unique opportunity to create value for unit holders. The unit buyback added approximately 40 basis points to leverage. We finished the year just below our 35 to 40% target leverage range, and we further reduced our exposure to rising interest rates at 75% hedged as of year end. Let's turn to our market and portfolio update on page 6. In stark contrast to our unit price performance, data center fundamentals improved significantly over the course of the year. According to Data Center Hawk, market vacancy is hovering in the low to mid-single digits across our 5 core markets. In Northern Virginia, our largest market at 35% of annualized rent, supply remains constrained, vacancy is incredibly tight at 1%, and market rents improved significantly over the course of the year. The pronounced market rent growth drove an increase in Northern Virginia asset values, more than offsetting a slight uptick in value or cap rates. Across the portfolio, total asset value was down approximately 1%, or down roughly 20 basis points on a constant currency basis. The robust data center market rent growth and continued capital flows into the asset class support the value of our assets, buttress our leverage, and validate the capital allocation decision to repurchase our units at a deep discount to intrinsic value. Our Toronto asset was the primary offset to the higher Northern Virginia asset values, partially due to the stronger US dollar and partially due to a customer bankruptcy. As previously disclosed, we reached an agreement with the bankrupt customer to allow for an orderly exit by the 31st of December, and they vacated the premises effective the 1st of January 2023. As you may recall, we reached an agreement with our sponsor earlier last year to make us whole for any cash flow shortfall through the end of 2023 related to this customer bankruptcy. Just before the end of 2022, we also executed a short-term lease agreement with an investment-grade cloud service provider to release half the bankrupt customer's footprint at the same rent. We are proactively working with the sponsor's sales force and portfolio management team to backfill the remaining vacancy. Given the strength of the Toronto market and the sponsor's global platform, we remain cautiously optimistic on the prospects for backfilling this capacity with no impact to DPU. As for the near-term demand outlook, the tightening cycle is beginning to have an impact on economic growth. Enterprise customers have begun to optimize their IT spending, and numerous technology service providers have announced job cuts in response to the expected slowdown in the growth of their business. However, data center demand is not directly linked to job growth. While the leading technology service providers may be reining in human capital, they're continuing to invest in digital infrastructure. Demand for core data center workloads remains robust, and we expect to see continued growth in digital spending as a percentage of global GDP over time. Let's turn to our full year results on page 7. Thank you. Central banks embarked on a tightening cycle in 2022, raising interest rates farther and faster than we had expected. We were initially caught offsides, but adapted to the shifting landscape by establishing a minimum fixed rate policy, executing a series of interest rate swaps, and ending the year with 75% of our debt hedged against rising rates. The sharp rise in interest rates over the course of the year had roughly a $5.4 million impact to DPU, or nearly half a penny per unit relative to our forecast. However, fixating on the interest rate impact masks the underlying operating performance. Cash net property income was $1.7 million, or 3% better than forecast, a particularly impressive performance given the portfolio is predominantly fully leased on a triple net lease basis. We picked up some additional savings from lower than expected trust expenses and non-controlling interests, and we generated another 1% DPU accretion from the unit buyback in December. All told, we managed to offset more than half the impact of the rapid rise in interest rates through a combination of proactively containing controllable costs and executing accretive investments. Let's turn to sustainability on page 8. We recently published our inaugural sustainability report with reference to the Global Reporting Initiative standards. As part of the publication process, we conducted a materiality assessment to determine which ESG issues are most material to our business by engaging with internal as well as external stakeholders, culminating with the 9 issues you see represented in the infographics here in the middle of page 8. We believe ESG is a continuous journey, and while Digital Core REIT is still at the outset of its journey, ESG is a top corporate priority for the organization. We are committed to integrating material ESG issues into our strategy and business operations to promote the development and adoption of sustainable corporate practices and policies. We are also committed to regularly and transparently communicating with stakeholders on our ESG performance, risks, and opportunities. Finally, we're committed to doing our part to create a more sustainable future for our customers, partners, employees, and the communities we serve. Let's turn to our distribution and AGM details on page 9. We made a second half distribution of 1.92 US cents on the 31st of March to unit holders of record as of the 10th of February, bringing our 2022 full year distribution to 3.98 US cents, again within 5% of our IPO forecast, despite the headwinds from higher interest rates, rising energy costs, and the customer bankruptcy. As mentioned, we managed to offset approximately half the impact of rising interest rates through a combination of proactively managing controllable costs and accretive investment activity. We expect to repeat the same formula in 2023 to maximize distributions to unit holders. We published our inaugural annual report and ESG report on the 27th of March, and we expect to conduct our annual general meeting on the 20th of April. As previously mentioned, we would very much appreciate your support on the resolutions to receive and adopt our 2022 audited financial results, to reappoint KPMG as our auditor, and to refresh our general mandate and unit buyback mandate. For complete details, please see the AGM and EGM page under the Investor Relations section on our website at digitalcorereit.com. Finally, before we open the call to Q&A, let's turn to page 10 to discuss our external growth roadmap. Our portfolio is almost fully leased, but we are keenly focused on backfilling the remaining vacancy in Toronto from the customer bankruptcy and driving additional upside through the lease up of the recently acquired vacancy in Frankfurt. We intend to continue to drive operational efficiency through proactive management of controllable costs. We maintain a flexible balance sheet at 34% leverage, with 75% of our debt hedged against rising rates. 100% of our debt is unsecured, and we own the freehold to 100% of our assets. We have $25 million of cash on our balance sheet, plus $200 million of availability on our completely undrawn line of credit, and our weighted average debt maturity is nearly 4 years. We intend to preserve the flexibility of our balance sheet while prudently utilizing our debt headroom to continue to execute upon accretive investment opportunities, expand our asset base, and enhance our geographic as well as customer diversification. The current data center fundamentals and long-term digital demand trends are highly supportive of our business. In addition, we continue to enjoy strong support from our sponsor, a leading global data center owner and operator. We believe our sponsor acquisition pipeline is unparalleled in the industry, and we have a unique opportunity to source accretive investments in state-of-the-art digital infrastructure across the globe. In summary, we believe we have a long runway and a tremendous opportunity to create long-term value for unit holders. Thank you again for your continued support of Digital Core REIT. With that, Mr. Gerald, we'll turn the floor back over to you.
Thank you. Thank you, John. I'll take you straight to asset acquisitions as the area of first questioning, but we've got questions coming in from unit holders. I will definitely attend to them. But firstly, John, the REIT also made its maiden acquisition, 25% interest in a data center I think this is located in Frankfurt, Germany, I think. The
Correct.
acquisition was scaled back because market sentiments didn't permit equity fundraising. So as a result, Digital Core REIT acquired 25% of the Frankfurt asset, but not the Texas data center. So the main question is this: how has the newly acquired asset performed? Even after the acquisition, the REIT's aggregate leverage is 34%. The debt headroom is approximately, I think, US 468 million before the 50% limit is reached. So the question is the REIT still actively seeking for other acquisitions? Is the Texas data center still on the radar and in the pipeline?
Sure, there's a lot to unpack there. Let me attempt to address those. And Dan, please chime in if I miss anything. First and foremost, in terms of how the asset is performing, I'd say it's performing right in line with expectations. It was, of course, 91% leased to predominantly hyperscale, excellent credit quality, leading global cloud providers. So, and several years of remaining lease term, so no change, performing right in line with our underwriting. And as far as the remainder of the question, I would say yes. As I mentioned in the prepared remarks, we are still open for business, although you highlighted the headroom relative to the regulatory limit. I don't think we'd push it that far, particularly in the current environment where, knock on wood, hopefully this banking crisis is not a systemic global crisis, but I would say we're certainly more mindful of preserving liquidity and leverage than we might have been 6 or 9 months ago. So yes, we will still look to make accretive acquisitions. I think we'll obviously have to be very selective. And quite frankly, I think what you saw in Frankfurt with the Frankfurt acquisition is more of a template in terms of what we would look to do. And by that, I mean specifically in the current environment, we're probably limited to acquiring minority stakes in assets. Data centers are pretty big assets, a couple $100 million at a pop. And so I think you'll probably see us take down smaller stakes in individual assets. As far as the Texas data center, that is definitely still part of the pipeline. However, I think practically speaking, as I'm sure you're well aware, interest rates in the US have moved up farther and faster than most other regions around the world. And so, part of the reason that we were able to still structure an accretive transaction in Frankfurt was because we were able to raise euro-denominated debt and match the currency of the asset with the liabilities. So it'll be more challenging in the near term to structure an accretive transaction in the US. So I think that we will look to be active in regions outside the US. Dan, anything that I missed there?
Thank you, John. But let me move to assets portfolio. We have to address the growing pains. The REIT experienced a customer bankruptcy at 371 Gough Road, your asset in Canada. I understand that they moved out on 1st of January 2023, and you have replaced half of that, of the income.
Correct.
So the main question, John, is from April 2022 to the end of 2022, did the REIT suffer any loss in rental income due from the customer?
The short answer is no. They remained current through the end of the third quarter, and we had a deposit that covered a couple of months. So we were able to get through the end of the year with no impact. And as you know, the sponsor provided a cash flow support that we have to draw on in 2023. And of course, we've already managed to release half of that footprint. And so we're working hard to release the remaining half.
Okay, so a follow-up question. Could you also update your unit holders on the new customer and the new leases? How much of the 37,000 net rentable square feet has been actually leased out? Are you able to achieve better rates?
Sure. So I would, again, I would describe that customer as an investment grade cloud service provider. And I would say that so in terms of the footprint, they lease half of it. So we've got half done, half to go. And the rent was the same for just to be clear, for the half that they're occupying, that the rent was unchanged. So there's no rental reversion up or down on that half of the capacity.
And half to go, John. What's the
Yes, sir.
timeline you have for the half to go to be fully occupied?
Sure.
Yeah.
Sure. Well, I mean, obviously, to the extent that we are able to release it before the end of this year,
Yes.
then we'll be able to, make good on backfilling without any DPU impact because of the sponsor support. So that's what we're focused on, is releasing it as quickly as we can, but certainly hopefully before the end of the year.
John, there is a question from one of your unit holders, Seng Bay. What is the concentration risk facing the company now? Any key tenant affected by the macro factors as well as bank crisis in US?
Yeah, it's a great question. I'm sure
Yes.
in the pre-submitted questions, I saw a number along these lines. So I'm sure we will, we'll delve into that further.
Yes.
I would say, look, the only customer that I would say has been affected by the banking crisis is the second largest customer, which they've got basically all their debt coming due in 2024. And so, that's a challenge. Their underlying business is actually quite strong, but they do have a balance sheet issue that they need to address. But the rest of the customers, and I expect we'll touch on this a bit more in follow-on questions, but all of the rest of them our customers are, very strong, creditworthy, investment grade companies, not really affected by the Silicon Valley Bank fallout or anything like that.
Right. We have another question from Yin Sir. What are implications from the potential bankruptcy of second largest tenant, and what are mitigation steps? What mitigation steps have been taken so far?
Sure. If I may, let's why don't we go to page 13 so that we can pull up the customer roster and have that on hand for everyone. So one point I want to make here is, and again, I think we'll address this in subsequent questions as well, but we disclose the credit ratings in the IPO prospectus, but this presentation that we've posted here for SIAS this morning, this is the first time that we've posted credit ratings since the IPO. Right. And this is something that, that we're going to commit to do going forward, because I do think it helps to provide obviously a good picture of the business. So, a couple of points to address the specific question. I would say, first of all, the second largest customer has had their credit rating downgraded, obviously to below investment grade, and so there is certainly the capital markets are signaling risk there. However, I would call out a number of points that we feel stand us in pretty good stead. For starters, they are, again, as I mentioned, they really have a balance sheet issue, not a cash flow issue. They're generating about $240 million of EBITDA, so pretty significantly generating significant cash flow. In addition, look, one of the overarching points is that when you own good real estate, you tend to have good outcomes, regardless what happens to the underlying customers. So this particular customer occupies 5 buildings, 3 in Silicon Valley and 2 in Los Angeles. Silicon Valley in particular is an incredibly tight market from a data center perspective. There's no new supply. There's no available supply and no new supply really able to be brought online until 2028 at the earliest. Their in-place rents are meaningfully below market, like 40 to 60% below market. So, and this customer also discloses their end user utilization. In Silicon Valley, they are 94% leased. So that suggests they are very significantly cash flow break even in those assets. So really, it's, I'd say several points. First of all, it's premature. They don't have any debt maturities in 2023. They have a wall of maturities in 2024, beginning in April of next year. So they have 12 months to sort out their balance sheet issues. If they are unable to refinance at that, that's the point at which they would potentially file bankruptcy. But it's obviously, premature to speculate at this point that would be happening. But hypothetically, if it did, if they were to file, then I should point out as we've disclosed, they remain current on their rental obligations to us. So there's no past rent unsecured claim to litigate.
Okay.
If they were to file for bankruptcy protection, then they would have the ability to choose whether to affirm or reject leases. We can't predict with certainty what's going to happen, but I can tell you when you are 94% utilized and your rents are 40 to 60% below market, I think there's a very good chance that those leases would be affirmed in a bankruptcy court scenario. But if they're not, then we have several lines of defense. First of all, we could, we have the very good fortune of being sponsored by a data center owner and operator who knows how to operate these buildings. So they could absolutely step into that customer's shoes and reach direct agreements with the end user customers in the space. So that, in other words, Digital Realty could operate the building as a co-location facility. The assets they're currently leased as shell and core facilities. So we could also turn around and release them as shell and core facilities with very modest CapEx requirements, like on the order of a couple of $1 million per building. And again, we would probably do, the wild card would be how much downtime you would need to release the facilities. But I think that we would do very well in that situation, given the fact that the in-place rents are meaningfully below market. And then the third option we would have is we could potentially invest additional CapEx to build out, what we call fully fitted facilities, and then lease them as turnkey users at much higher rents. And again, you've got the trade-off of cash outlays, cash outflows, and potential downtime while you're waiting to release it. But the upside could be meaningful given that the in-place rents are below market. So hope that provides some perspective on the situation.
Thank you. There's another question from James Chias. Digital Core market price has plummeted significantly from its IPO price since its listing a mere 15 months ago. While I'm aware that market prices are not within your control, can you offer any explanation for the dismal performance of its share price?
I'll try, and
Yes.
Dan, please chime in, because you're close to it as well. First and foremost, look, I think the world has changed, right? So I would say in December of 2001, for one thing, we were not expecting that Russia was going to invade Ukraine, right? If any of you on the call did predict that, then hats off to you, and please take me with you. But at any rate, clearly the macro environment has changed meaningfully. Russia's invasion of Ukraine caused a spike in energy costs. That, quite frankly, was what led to the customer bankruptcies, specifically the inability to pass through higher energy costs in the UK in particular. In addition, it helped touch off outsized inflation in the US, and the Fed obviously has been combating that by rising interest rates very quickly. Like I said, much more farther and faster than we had anticipated. And I think the impact of interest rate has been threefold. First and most obvious is the impact of DPU, right? As we talked about the $5.4 million hit to DPU. That's apparent. And look, quite frankly, I think that's one area that we should have done better, right? We should have managed the capital structure better out of the gate and not been as exposed to rising rates. But the first, the impact on DPU is fairly straightforward. I think a lot of investors, quite frankly, were focused, and we obviously believe, and the valuers would tell you, perhaps needlessly so, but people were worried about the impact on valuations. Again, data centers in particular have proven to be sticky, and I think a big part of what has been missed by the unit price performance has been underlying data center fundamentals, but I'm sure we'll talk more about that. And then finally, this may be, maybe many of you on this call would have drawn this conclusion, but perhaps not. I think part of the reason that institutional investors subscribed to the IPO was because they looked at a $15 billion investment pipeline, acquisition pipeline, and they looked at our cost of borrowing at 1% and cap rates at 4.5%. And they said, look, these guys have an opportunity to create value all day long. And as interest rates rose quickly, I think the value that institutional investors were ascribing to external growth was, they've significantly revised their calculations. Now, I think Dan and I would tell you that we've demonstrated that we are able to continue to do deals like we did with Frankfurt, and we think that we can continue to, even in the current environment. But nonetheless, some investors have just, they've re-rated our prospects as a result of that. Then, obviously, look, very unfortunate that our first quarter as a public company, one of our top 5 customers goes bankrupt. That obviously did not help matters. I think that perversely, when we did announce an acquisition, it was, we felt we were delivering what unit holders were clamoring for, but in practice, we wound up basically creating an overhang because investors were expecting us to raise equity to fund the deal. And so I think that kind of backfired, quite frankly. And then two, look, there was the Section 1446F tax withholding requirements, which obviously does not apply to us, but that caused a lot of people, I think, to shoot first, ask questions later. And so we were dragged down, particularly late in the year, by some firms' interpretation that unit holders would be subject to withholding tax in the U.S. That had an impact. And then I think we've seen into 2023, obviously continued worries about technology companies, broadly speaking, and most recently the banking industry, Silicon Valley Bank and Credit Suisse. Obviously, we don't have exposure to those firms, and or directly to technology companies that are startups or backed by venture capital. So I personally believe that a lot of what has transpired has been, some has been valid, but a lot has been at best an overreaction, and it does not match. There's a big disconnect between fundamentals and valuations and what we see playing out in terms of the unit price. Dan, I know I've been rambling, but do you have anything to add?
Yeah, maybe to kind of help summarize, I think what John was saying there. I think obviously coming out of 2021 and 2022, the world changed quickly, right? I think there are a lot of factors going on in terms of high inflation, interest rate hikes. But at the same time, obviously, as a management team, we don't take that as an excuse, right? The question for us is, how do we react to things that affect us? And I think John listed a good list of items that obviously impacted Digital Core REIT specifically, and obviously had an impact on our stock price. But I would also say, as I think James highlighted, thank you for acknowledging it, we don't control our stock price, but what we do control is the actions we take to mitigate and address issues that arise, right? So one is the rising interest rates. I would say we are now 75% fixed. We've obviously swapped our floating to fixed rate debt throughout the year, and that's one thing that we addressed. Obviously, the unfortunate kind of energy crisis that occurred had some impact to our top 5 customer, which caused a bankruptcy situation in our Toronto asset. But I think you saw how we quickly reacted there, and obviously got sponsor support via cash flow support agreement, as well as obviously quickly releasing half of that rental stream before year end. And I think when you look at the acquisition strategy, I think we were pretty thoughtful. We were having 2 options, and one which was around doing a modest size that diversified and grew our portfolio by 10%, but also maintain liquidity in a market that was rapidly changing. And I think that's one thing hopefully investors can take comfort in, is that, look, if we can't control everything that's happening on the world, I think obviously no one predicted the bank collapses that occurred a month ago, and that's kind of new. And obviously that could have an impact to our customers. The main question here is, do we have good assets in good markets, which we strongly believe we do. And I think to the questions that the unit holders have been asking is, what are your mitigation plans and how do you react to those things? Because it could be out of our control. And hopefully, I think what John highlighted in the prior question is we have plans in place, and hopefully unit holders take comfort that we've obviously done our diligence right with this customer and these assets and these markets, and develop contingency plans in the worst case scenario in terms of what could happen here. And even in light of that, we think we can come out here with a good outcome. And I think that's really attributed to the fact that we are, a S-REIT focused on an attractive sector. I think, John highlighted digital infrastructure, right? When we say infrastructure, I think that's a key distinction from traditional, just like real estate, right? And the reason I say that is, you think about infrastructure like roads. You need roads to go from point A to point B. You need data centers to transmit information from one place to the next. It's hard to get rid of that infrastructure. It's critical to how we work, how we live, and how we do business. And I think that's a key distinction that we have as well. I think John and I are fortunate that we are obviously a REIT that's focused on that sector, and we have assets in markets that are doing very well with strong growth and rising rents. So I think hopefully that gives the team here some comfort. And look, obviously as a management team, we promise to continually keep our eyes open in terms of an evolving market environment and being proactive in how we manage and mitigate risks that pop up. I think we're just unfortunately, last year and a half, I think since we all started on, there's been a lot of unforeseen risks that have popped up, and it's been very different from the prior 20 years where we're dealing with a very upmarket environment.
So is it a concern for both of you gentlemen that the big technology companies like Amazon, Microsoft, Alphabet are building their own data centers? Are you worried? Ju Seong Chai has asked this question.
No, we're not worried. I mean, that quite frankly has been happening for years. They build a lot for their own account, but there's plenty of business to do with third-party providers. It makes there are some specific instances when it makes a lot of sense to outsource rather than insource, and I would say in particular, they will build a lot for their own account close to home, where they have an existing team and infrastructure that they can leverage, where they're very familiar with the local permitting and building requirements. They've got a lot of leverage. They can negotiate with local municipalities and service those facilities with their existing teams. They tend to rely on outsourcing a lot more when they're not able to achieve the same economies of scale, and specifically that happens a lot internationally and in Europe in particular, partly due to data sovereignty laws that require the data to reside within a particular country. So you can't necessarily service all of Europe from a central location. German data has to reside within Germany. In those situations, as you can imagine, it's not as easy for let's say a US-based company to achieve scale, and certainly not to be as familiar with they're not in the business of developing real estate in foreign countries, right? It's not a core competency of theirs. And so there are a number of reasons why In some instances, it makes sense for them to build for their own account, but they do a lot of leasing from third-party providers such as Digital Realty and others.
Another worry, John, any likelihood over the next 2 to 3 years that you may ask unit holders to contribute to equity fundraising to fund the intended acquisitions, even if such acquisitions will be of smaller stakes? James Chias asked that question.
Dan, why don't you kick that off, and maybe I'll chime in.
Look, it obviously, we kind of set this.
Right, equity fundraising.
Yeah, obviously at these unit prices, we're more buyers than issuers of equity, right? Obviously, we see a deep disconnect. And obviously, we don't think the equity cost of capital here is attractive for us to issue equity at these levels. So that's why I think you're hearing from John that we're being mindful with acquisition strategy. And that's part of the reason why we chose to do a modest acquisition last year versus the larger acquisition.
Okay, but so you're giving the assurance not likely, right?
Not at these levels.
Certainly not at these levels. We hope to be able to issue equity to fund acquisitions, but it would need to be accretive, right? Which means the unit price would need to be a lot higher than it is today.
But will you expect your cap rates to increase? And to what levels, if so, to what levels with the impending recession? Nguyen Yo asked the question.
Yeah, I mean, look, interest rates continue to head higher, right? So it's not out of the question that you could see some cap rate expansion, but I could tell you that to date, data center cap rates have remained very sticky. And that's, it's due to a couple of reasons. Number one, like if you look specifically at the valuation of our portfolio that took place for the balance sheet as of December 31st, we had some pros and, some assets were up a little bit, some were down a little, but we actually had, so cap rates were up about 25 basis points on average across our portfolio. However, that was dwarfed by the market rent growth that we saw in Northern Virginia, which kind of gets back to Dan's underlying point that what you're seeing in the on the tape with the unit price does not match what's happening with fundamentals. So data center fundamentals are tighter than they've been in years. So look, it's possible we could see some modest cap rate expansion, but I can tell you there's a lot of money that is looking for a home in data centers that are under allocated. A lot of people in a lot of office buildings. A lot of institutional investors are under allocated to data centers as an asset class and would like to have an allocation to these buildings. And there's really there's a finite investable universe. And so there's still a pretty healthy bid for data center assets. Like I said, it doesn't appear that we're completely done with the tightening cycle. So it's possible you could see a little bit of cap rate expansion, but I'm not expecting any kind of material erosion in asset values.
Okay, so whilst we were just talking about interest rates, John, the REIT's weighted average all-in interest rate was 2.7% for 2022, right? Against a forecast of 1.2%. So the question, the REIT progressively hedged its interest rate risks with 50% in the first half and an additional 25% in the second half. So the question is, in retrospect, all the REITs might have wished that they have hedged more and hedged earlier. What is the manager's view on interest rate trends going forward? And when do the interest rate swaps expire?
Dan, you want to take that?
Yeah, why not take that? So obviously, it's hard to have a crystal ball and predict where rates are going to go. And obviously, we've seen the treasuries climb up north of 4% and also decline to low 3% in like a short span of a few weeks. However, I think as a manager, what we're trying to do here is provide predictability in DPU. And we've done that by obviously now increasing our fixed rate debt up to 75%. And I think that's a level, currently calling around the 70% area, which is in line with our peers that we feel comfortable about. So I think that's part of the strategy that we mitigate with that. And obviously, as we plan internally, we the forecasts as well. But obviously, I think for us, the main thing is how do you mitigate that risk and limit any sort of exposure to that potential rising interest rates. And I think we've done a good job of that now heading into 2023. And I think going to your second question, the swaps, we have a number of swaps and the weighted average tenure on them is roughly 2 years.
Okay. Can you please share more about strategy of the REIT? Kindly be specific. Example, what is the target geographic split with geographies or countries plus what type of tenants, etc., Daryl, from Daryl. Can you take that, John?
Sure. I mean, we don't have specific targets in terms of geographic regions. I would say we definitely would like to have a presence in the Asia Pacific region, and so I think that you can expect over time to see us look to be active in the region and diversify globally. I think that's really a strategic imperative is to achieve greater diversification, quite frankly. So that's something that you should look for. And I'm sorry, what was the second part of the question? Which
geographies or countries plus what type of tenants?
In terms of types of tenants, we predominantly hyperscale, strategic customers, and strategic means repeat buyers with long-term established relationships who value our offering, our value proposition.
Right. So your strategy is really to look for quality clients, tenants, and to ensure that you've got a couple of guys who are on the verge of bankruptcy or who may be going into bankruptcy. That's something that you can't see the crystal ball how it's going to be in the future. They come in with good balance sheets, but all depends on. But recession is looming in quite well in America at the moment. I think you're doing all right economically, but there's a lot of other geopolitical factors that worry investors. How worried are you?
Let me speak to customers briefly.
Yes.
And then certainly happy to talk geopolitics as well. First of all, I would say, look, all else equal, we certainly prize credit quality and stable cash flows. But I would say you certainly have to, I would say we're not going to redline any particular customer. At the end of the day, we're focused on pricing risk and return appropriately, right? Achieving proper risk-adjusted returns. And so, look, our largest customer is AAA rated, and if you'd had assets in Silicon Valley that were leased to a AAA rated customer, I can assure you that the cap rates would be dramatically tighter than the assets that we contributed at the IPO. So again, from perspective, strategic customers generally are large, stable, well capitalized, but also repeat buyers who value our value proposition on a global basis. So I just wanted to stipulate that point. In terms of geopolitics, I would say, we're marginally concerned, but there's a lot that we don't have control over. I'd say we are obviously, I think we're more mindful, quite frankly, of the banking situation than the prospect of a shooting war outside of Ukraine in the near term. There's a lot to worry about, but there often is, right? It was the best of times, it was the worst of times. So I'd say we're particularly mindful of preserving leverage and liquidity in the current environment, and obviously keeping a close eye on what's going on around the world.
And maybe John, if I could add, maybe you can go slide 13 and maybe put that on the screen and just help unpack this kind of our customer base for unit holders here a bit. So you look at the bottom left chart that says, investment grade, non-investment grade. The non-investment grade only 25%. And we look at the right, I think we've been talking a lot about our number 2 customer, which is 23%. Our profile, the remainder 2 that had declared bankruptcy last year and had moved out effectively January 1st. So when you remove that portion out, really our non-investment grade exposure here is that number 2 customer, right? And obviously we talked about the lines of defenses and contingency plans. But when John and I look at the rest of the portfolio here, John spoke about the number 1 customer. You look at the rest, these are well-capitalized customers who have strong credit qualities. So we actually think our portfolio, look, if you take out the number 2 customer, is actually quite well positioned. In addition to the fact that we're located in strong markets, we're rising rents. So I think when you look at this potential upcoming recession, I think we feel comfortable kind of with our prospects as a company, and we also feel comfortable with our prospects tied to the data center sector. Because as I said before, there's a delineation of difference between critical infrastructure required to operate businesses versus other asset classes in real estate.
Well put. Thank you, Dan. Mr. Chair, I think you may be on mute. I think you're still on mute. I hope this is a tough question. I'm afraid you're still on mute.
Mr. Gerald, we can't hear you actually.
Okay, can you hear me now?
We can hear you now.
Okay, John, you have touched briefly on diversification of portfolio to avoid over-reliance on tenant, given the turnaround of events, isn't it? You have touched on it briefly. But yeah. Secondly, John, you mentioned some line of defenses. Jim Tan says that's great, but what would be a longer-term contingency plan? There is a chance sponsor may not provide guaranteed income support if your customer defaults. Is that a worry for you?
Well, I think a default would certainly be worrisome, but look, our long-term contingency plan in that situation would be to release the assets. And like I said, I think a really key point to remember is that when you own good real estate, you tend to have good outcomes. And so, we feel very good about our ability to keep our assets leased, which is in large part due to the sponsor's platform. I mean, it may be almost difficult to fathom or difficult to imagine, but we have a tremendous benefit. The team that we are able to leverage and their familiarity with the data center business, these markets, these customers, the sponsor has 4,000 customers, right? So anybody else who is going to try to release a data center, it's really kind of like a rifle shot. But when you have literally the largest global owner and operator as your sponsor, you're a huge sales force who's focused on selling inventory on your behalf. That's just a tremendous advantage. And so, our contingency plan would be to release any vacancy that we have in the portfolio.
And I can just add on to that a little bit. I think it's important for you to remember that the sponsor is our largest shareholder, Digital Core REIT, right? They hold roughly 36%, right? So they share the same pain and frustrations about what they've seen happen to our unit price. I think at IPO, they had roughly $250 million USD in Digital Core REIT, and they've seen half of that go away, $175 million, right? And they also own 10% of all the assets in the US and Canada and 75% of the asset in Frankfurt. So I would say that to me is a clear alignment of kind of them wanting to see the success of Digital Core REIT and the outcomes. And I think that's also complementary to what John said in terms of a best-in-class operator that knows these assets and markets very well. They can provide us real-time feedback on as you said, contingency plans and how do we plan ahead and think through the best outcomes for the REIT. I think, look, it's unfortunate what we've been dealing with over the last year and a half. I think the market's been very up and down and volatile, and obviously we take in our fair hit on these things. But I think as a management team, we also need to be focused on the right long-term focus and strategy, which we still feel really good about, while also mitigating the short-term risks that are continually arising that have been unpredictable. And that's something that we are focused continually doing and responding to. But also, I just want to just reiterate that I think sometimes it gets lost that our sponsor here has a significant interest in Digital Core REIT.
Thank you, Dan. Last question, gentlemen. Are you taking advantage of the inverse yield curve to push out the interest rate swaps expired? Tan Soping.
Yeah, so obviously when we enter an interest rate swap, we're taking different tenures and different terms on them. So sometimes that does yield, I guess, the inverse yield curve does give us that sort of advantage, but that's more just a function of pushing out the maturities and the length of our swaps, right? Because obviously, if you were to swap on a 1-year basis, that's more a higher interest rate than a 2-year basis, just the way the inverse curve is working.
Right. Thank you, gentlemen. It's been a very interesting morning. Thank you for taking all the questions, giving your best answers. I'm sure unit holders have enjoyed hearing you, and they've got a lot in their pocket now. But any more questions you have, please send it in. I'm sure Dan and John will be happy to answer them if you have. And for unit holders who are in Singapore, we are having a members night, SIAS members night on 19th of May. Don't miss that. And complimentary SIAS membership is available for unit holders. So be in touch with my office and please participate in our activities. John, Dan, thank you very much. Have a good day.
Yes. Take care.
Thank you.